It is 3 p.m. live from our studio in New York City. I'm Julie Hyman, that's Josh Lipton, and this is Yahoo Finance Live. Here's what we're watching this afternoon, an hour away from the closing bell on Wall Street, and stocks are searching for direction. The S&P 500, very little change right now. It's very close, though, to that 5,000 level, and breaking above it for the first time ever will be on 5K watch. What's keeping investors perhaps on the sidelines, and why one top strategist says it's time to de-risk straight ahead.
And the AI-fueled rally showing no signs of slowing down. ARM Holdings exploding higher on upbeat sales guidance as the chip designer says the rapid shift to AI is helping boost sales. That stock has more than doubled since its IPO last year.
Plus, Bitcoin is climbing back above 45,000, and that is giving a lift to crypto-related stocks. We've got to look at what's driving the march higher later this hour. Get you up to speed on the market action right now as we are watching all three major averages now in the green, but the S&P 500 has been trading in a very narrow range today. You can see the Dow not much changed either, just about 16 points to the upside. The Nasdaq getting a little bit more momentum, but not much, up just 0.25% here. We've got energy stocks actually as the best performers in today's session within the S&P 500, followed by real estate, utilities, and financials, though, pulling in the other direction. So that's what's equaling that virtually unchanged level when it comes to the S&P 500, Josh.
You know what I thought we'd start the show with today, Julie Hyman? I thought let's take a beat, let's take a breather.
Okay.
Just like look at earnings season, you know? Kind of just
I thought you were going to like have an existential kind of butterfly moment.
I always do
there.
when I'm talking financial markets. Even if you can't see it, it's there. We are well into fourth quarter earnings season. So how are the numbers stacking up so far? Let's take a look. According to FactSet, as of February 8th, 75% of all S&P 500 companies have beat EPS estimates for the fourth quarter. So, Julie Hyman, here's an interesting story, is what's driving that a bit, right? Let's talk about that. I thought our own Josh Schaefer had a good piece, which is well what the read, kind of looking over that. And one big trend, what's been driving the beats, and we've been talking to analysts about this too, it's been margins. It's a margin story. These companies, they're in cost-cutting mode. They're getting leaner and meaner, so margins improving, and companies have been delivering.
Well, and once again, analysts and investors keep looking for declines in earnings, and companies keep beating estimates, which is also writ large. I mean, yes, it's about cost-cutting, but it is also about demand, right? If you look at the underlying economic figures as well, you look at consumer spending, you look at consumer sentiment, you look at the job market, for example. Holding in there. Yep. So all of this sort of confounding the most pessimistic views out there. If you looked and break it down sort of by group and where that earnings power is coming from, we've talked about it before. A lot of it is coming from the so-called Mag 7. It's coming from communication services. That's the group that's having the biggest percentage gain in earnings this earnings season so far, followed by consumer discretionary utilities, actually, and information technology.
Yeah. You know, another big theme, which we've talked about, is China, which is interesting. But the issue there, which has been so interesting, is that you can't really find this kind of common narrative. Ed Yardeni, and we've had Ed on the show, very well-respected economist and strategist, he was talking just this morning with his clients about that. He was kind of delving into it. There isn't one storyline. And for example, he talked about how he picked two names out of a hat, kind of Air Products and Chemicals, which is a company we've talked about. Now, when they talk about China and what's ahead, it wasn't so great, not so rosy.
Right.
Estee Lauder, on the other hand, right, when they talk about China and what's ahead in the back half of the year, much more rosy, much more optimistic.
Although things have not been going very well for Estee Lauder. And then you've got Ralph Lauren also, that is saying that things are a little bit better in China. So
it's almost, so if you're looking for one storyline that hasn't been there, I guess, one takeaway is if you're an investor, you're kind of having you got to pick your spots right now, at least on that theme.
Yes, most definitely. It's not a very clear picture on that front. All right, so with strong earnings overall and a recovering economy, it may seem like everything's going well, but one strategist says it's time to take a step back and de-risk. For more, we want to welcome in Emily Roland, John Hancock Investment Management Co-Chief Investment Strategist. I was really struck by this in your note, Emily. You said, everything is awesome. Maybe you should be a little suspicious, I don't know, of that kind of, when everything looks this rosy. Why does that give you pause, and what do you want to do in reaction?
Yeah, Julie, I had a feeling you might choose that one very last sentence I wrote in my notes to hone in on. But, we're looking at this environment where everything, first of all, has gone really well for the Fed. We've had a period where growth has seen a modest reacceleration. The labor market remains really robust and resilient in the face of higher interest rates. And at the same time, you've seen disinflationary trends continuing. The Fed, of course, wanting to see a little bit more in order to confirm that inflation's coming down, but everything's going really right today. And then you're also seeing, as you've mentioned, earnings growth picking up. Expectations at the start of this quarter were for negative earnings growth, and now we're about 2/3 of the way through Q4 earnings season, and we're looking at almost 3% earnings growth. Of course, that's been concentrated, as you guys mentioned, in some of those mega cap tech names, but there's a lot of things going right. And when we look at the market dynamics today, areas like small cap equities are really perking up, and looking underneath the hood, there's a lot of crypto related assets there. So it feels like there's a lot of risk taking going on. Sentiment is getting, maybe a little bit ahead of us here as everybody continues to celebrate disinflation, better earnings, again, reaccelerating growth. And it's not that we don't want to participate. We do. We want to be invested in this market. We just want to be mindful about going over our skis and taking risk.
So Emily, so you do want to be invested. So given that backdrop, where in the equity market do you want to be invested? Where do you see value?
Yeah, so we've continued to have an emphasis on U.S. Equities over international. Again, economic growth holding in the best here across the world. We can see that through business surveys. We can see it again through labor market dynamics. We also have a preference for quality. These are companies with great balance sheets, lots of cash, low interest burdens, better pricing power. And if you want to own quality stocks, frankly, the poster child for quality is mega cap tech. And you're going to find a lot more of that, of course, in the United States than you are elsewhere. Now, the problem is that mega cap tech's gotten pretty expensive. In fact, if you look at the S&P 500 growth index, it's now trading at a 45% premium to its 20-year average. So there's a valuation issue there. The stocks can continue to deliver if their earnings are there, which so far they have been, but there does come into question, when do valuations kind of, cause us to take a bit of a pause? So we want to diversify away from tech, even though we still like it, by owning areas like U.S. mid-cap stocks, which are actually trading at almost a 30% discount to their large cap counterparts. And we see them benefiting from more secular themes around onshoring. We like the overweight to industrials as a way to play a lot of this fiscal spending that continues to happen in the United States.
Emily, I think your point about large cap growth is quite interesting here. And I just want to kind of linger on that for a moment, because I think a lot of investors right now, particularly in the wake of what was a mixed earnings season for the so-called Magnificent Seven, the largest of those mega cap tech companies, people are asking themselves, okay, now what? Do I hold it? Do I lighten up? Do I buy more? And it sounds like you're sort of in the hold camp, if I'm reading between the lines here. Is that effectively what you're telling investors? Hold on to those, but do some other stuff too.
It's hold broadly, but I want to make it clear that the Magnificent Seven, they come from different sectors. So you've got your traditional technology, S&P 500 tech sector, then you've got communication services, and then you've got consumer discretionary. So those 7 stocks are actually spread across those various sectors. What we would be doing is looking underneath the hood at where can you find quality within those sectors. And frankly, the classic S&P 500 tech sector ranks the highest on the quality metrics that we look at. So that's really where we would hone in. So maybe it's not about owning every single one of them. Maybe it's the Mag 5 or 4, or I'm sure we'll come up with some new name for it here in the future, but digging underneath the hood and finding where there's an overlap with quality and tech.
And Emily, I'd love to get your thoughts on China as well. I don't know if you heard, I was talking about that with Julie as we started off the show, and it's been hard to, Emily, kind of find a common narrative during this earnings season. It really does vary widely depending on the company, the sector, the industry. We'd love to get your thoughts on China. Do you want exposure there?
Yeah, we've been minimizing our exposure to China and emerging markets for a number of reasons. There's continued challenges with their property sector being over-levered. There's a kind of move away from capitalism as there's more control over many companies in China, which is less business friendly. So we've actually been, taking that underweight to emerging market equities and taking that into the United States, particularly by allocating to mid-cap stocks, which are benefiting from some of those supply chains in China actually coming back to the United States. So that's been an underweight for us broadly. In terms of other earnings themes, you guys nailed it earlier, talking about some of the cost cutting and restructuring in general that's happening. And what we're seeing is pretty typical dynamics for a late cycle environment where revenue growth is normalizing. It was explosive during the height of the pandemic as we pumped $5 trillion of stimulus into the economy. And companies are now contending with a higher cost of capital as the Fed raised rates. So margins are starting to compress. This is something we've been waiting for a while to happen. And if you're a company that wants to maintain profitability and your margins are shrinking and you can't raise prices anymore, you have to cut costs. And that's the way that a lot of these companies are really generating their profitability and beating those earnings estimates. So I think another notable trend that's playing out.
Emily, finally, I want to ask you about the Treasury market a little bit. It's been a big week for auctions, Treasury auctions. Today, there was a 30-year auction, and there's been strong demand for that all week, although we are seeing prices fall off a little bit today and yields go higher. What are you expecting that dynamic to continue to look like, and what do yields look like in the short term?
Yeah, it's a great question. And supply-demand dynamics can definitely play a role in moves in Treasury yields over short periods of time. And I think we've certainly seen a little bit of relief here as the markets absorbed some of those recent auctions. I think yields are backing up today on higher oil prices primarily. So I think there's other dynamics at play there. Over time, we see demand as being a more important part of the supply-demand equation as it relates to treasuries. So I think what you'll see is as we see a further deceleration in the economy going into the remainder of 2024, you'll start to see investors thinking about de-risking and embracing treasuries because, of course, that's one of the safest places that investors can go. So we think even though there may be some continued concerns around supply, that demand will come the overriding factor.
Emily, thank you so much for helping us kick off the show today. We always love having you. Thanks again.
Thank you.
Let's check in on some of today's top trending tickers. Shares of Confluent jumping today. That's after earnings topped estimates, and the software company said it expects revenue in 2024 of about $950 million. That is up 22% and ahead of analysts' expectations. So Confluent, let's talk application software, Julie. Let's do that. Q4 beat, full year revenue forecast also better than what the street had been looking for. I'm just looking over the commentary from analysts. They seem to like what they saw in this report. Matt Hedberg over at RBC, he's a smart guy telling clients this was, he called it a bounce back quarter, calls out what he also said were major milestones for Confluent, specifically, for example, cloud revenue hitting $100 million, continues to like the opportunity, rates this one outperform.
And this is an interesting one. So it was founded back in 2014. It did come public in that whole big class of 2021. In this case, in June of 2021 at $36 a share. And the stock today is having its single best day since that IPO with that big leg up that we're watching here. The high was back in late 2021, as it was for so many of those class of 2021 IPOs of $93.60. So it's still below that. It's still below the IPO price, even as we see that gain here. And so it looks like analysts are viewing this as some real progress towards, kind of recouping some of those losses. And some analysts talking about further upside going through the rest of the year as well.
Yep.
Yeah. Interesting stuff. All right, let's talk about Ralph Lauren. Those shares are also higher today as the luxury retailer beat third quarter estimates. Revenue up 6% year over year to $1.9 billion. A couple things going on here. One, China, as we already alluded to, was a strong area of demand for them. They raised prices again, the second year in a row. Average selling prices going up by 9%, and they're doing a lot more direct-to-consumer selling. Ralph Lauren, the model used to be, man, you got to get that in the department stores. And that model hasn't worked as well in recent years, so they've pivoted to doing more direct to consumer, and that has worked better for them seemingly.
Yeah, and speaking to that, there was a good piece in Bloomberg, kind of to your point, sort of ticking over the tactics and strategy of the CEO and kind of the moves he's made there. And to your point, Julie, they kind of went over, listen, growing sales in his own stores and website, that's been the priority, kind of decreasing reliance on the department stores, which have been more choppy, raising average prices, cutting discounts, and he's been rewarded. I mean, the stock's up now more than 40% over the past 12 months, and that just blows past S&P's Consumer Discretionary Index.
Right, definitely has been an outperformer in comparison.
Yep. All right, let's get to one final one here. Shares of Monolithic Power Systems rising after report fourth quarter adjusted earnings that beat analyst estimates. So this is a semiconductor device company that reported, Julie, Q4 results beat on the top and the bottom. Investors seem to like the outlook as well. Lots of talk about, you guessed it, on AI as well. Interesting note from the team at Truist. They comparing and contrasting, saying this company is showing what they referred to as remarkable performance relative to peers that are kind of struggling with industrial and auto demand and excess inventory. So Monolithic, they were saying, kind of navigating the waters here better than some rivals.
Yeah, this was one, full disclosure, and I'm disclosing on your behalf as well, Josh. This was one that we were not super familiar with, right?
Yeah.
It just was added to the S&P 500 in February 2021, so it hasn't been in the S&P for that long here. But, you know, and I feel like the semiconductor industry, in terms of size, has been expanding. And this one is one of those that wasn't necessarily on our list before. I mean, I think Confluent in the enterprise software realm is sort of in that category as well. And as we talk about the Mag 7 and the biggest of the big, there are a lot of these sort of, you know, they're not small cap, they're still large cap, but not the largest, that are also sort of standing out this earnings season, which has been an interesting trend to see. Yeah,
I am guilty of kind of sleeping on this one, but a lot of people have. This stock is now up about 60% in the past 12 months. It's a big move, and about 70% of analysts who rate this one still say buy it.
Interesting. Yeah. Well, and it's also trending on our ticker page today, so obviously people are taking note. Well, we're just getting started here on Yahoo Finance Live. Coming up, Google's AI bot, Bard, is getting a rebrand, and we've got the details on the other side. It's got a new name. You see it right there. Plus, shares of ARM Holdings soaring after third quarter results. We'll get analyst reaction and break down the numbers from the semiconductor designer late in the hour. Plus, another day, another round of earnings reports after the bell. We'll dive into the latest from Affirm, Pinterest, Take-Two, and more. We'll be right back. Google's AI bot Bard is getting a new name, Gemini, that matches the underlying AI software model, and a new premium version is going to come with a price. Our senior technology reporter Dan Howley is here to explain here what exactly Google is doing. So what are they doing here?
Yeah, so right now, well, I guess they did have a chatbot called Bard, right? And this was the chatbot that they kind of unceremoniously rushed out an announcement just days before Microsoft announced its then named Bing chatbot, which is now Copilot. Everybody's trying to figure out how to name things, right? So more recently, Google rolled out a new AI model. It's their most powerful model yet. It's called Gemini. And so they're trying to make a whole ecosystem out of this, calling the bot now Gemini. And so the bot is still going to be free. The general bot is going to be free. You can get it on iOS through the Google app. There's a little toggle where you go up to the top, you can tap and then go into Gemini. For Android users, you can actually use it to replace your Google Assistant. So if you hold long press the side button on your phone or you swipe up from the bottom corner, you would be able to then get an opt-in to use Gemini rather than Google Assistant, or you can download the Gemini app and just put it in your little tray. It's still a chatbot. It's obviously a powerful one, but the real, I think, money, literal money, is in the Gemini Advanced, and this is going to be part of the Google One AI subscription service. It's going to be $19.99 a month, and it's going to give you access to the Gemini Advanced model. This is their highest level model that they offer, and it's going to give you better capabilities as well as faster responses. In addition to that, you're also going to get 2 terabytes of storage. You're going to get Gemini within Google Workspace, so that means Gmail, slides, sheets, things like that. So you're still going to be able to get all of that as well. And I think that is. This is where they're coming to loggerheads with Microsoft, right? They're both offering similar products. Google is saying, look, we have this very strong model, and Microsoft is saying, that's cool. We have OpenAI's model and our own. So, and we're the enterprise leader. So this is where I think the two companies are really, really competing, and it's going to be very fun to watch to see who ends up winning this. Microsoft already saying though that they're adding revenue through AI to their Azure platform, which is massive.
Let me ask you, we were talking about it off camera, so now let's talk about it on camera for a second. It's really interesting in this competition. I did see some smart analysts saying, you know what, in this fight, in this competition, that Google should have some real advantages. One, the data, search data that goes back years, decades, and the distribution. What do you make of that?
So I think, it comes down to Microsoft is fighting basically a losing battle when it comes to the search, right? I mean, look, Google is Google, right? If I use the Edge browser, right? I don't use Chrome. I like Edge more. I think it's easier, and it's not easier. It's less cumbersome. It bogs down my gaming PC less. But I still use Google to search, right? It's just better. It's a better product. They're going to benefit Google from AI in that direction, with generative AI, through search, through chatbots related to and around search, and helping customers build ads. Meta's doing that already as well. Microsoft is going to benefit through the enterprise. That's where they're going to rock and roll. They have Copilot built throughout their enterprise stack. They also give customers the ability to build their own copilots through Azure. So it feels to me as though it's going to be, they're going to lead in their own respective lanes. They're still going to compete. Microsoft is still going to compete with Bing because they still sell ads through there. They make a good amount of money. And Google is obviously a huge competitor in cloud and enterprise, but I think they're still going to continue to be the leaders. Now they're just going to use this to be another competitive advantage in those lanes.
Yeah, 2 big companies with a lot of cash and a lot of smart engineers.
Yeah.
It's going to be a good fight to watch.
It's going to be very, very fun.
Yeah. Thank you, Dan. Appreciate it.
It's my job, baby.
All right, we move on. Thomson Reuters doubling down on AI. The company announcing today it will license the Reuters news archive to large language model companies. News coming after Thomson Reuters reported it beat on the bottom line during the fourth quarter, forecasts a larger than expected revenue rise in the year ahead, thanks in part to its ongoing AI investments. We are joined now by Steve Hasker, Thomson Reuters CEO. Steve, it is great to see you. I thought we could start, Steve, just help us think through the quarter. What drove the quarter, Steve, and what is going to kind of drive this acceleration in organic growth that you all see ahead?
Yeah, thanks, Josh. Good to be here. So we met or exceeded all of our targets and guidance for both the fourth quarter and also the full year 2023. So we're happy with that. I think, but more important or a greater source of pride is the speed with which we've been able to integrate generative AI in our core flagship products, starting in legal, in the content-driven technology that serves lawyers across the world, and it's soon to roll out into the products and services that we use to serve tax and accounting professionals and ultimately news professionals through the Reuters news agency. So that's really been the basis of the conversation that we've had with investors today since we announced our earnings. We're going to increase our investment intensity through this year, and we've talked about that with the implied return of higher and more profitable growth through 25 and 26.
Hey, Steve, it's Julie here. Of course, one of the questions that, investors ask one question, I think many of your clients probably are asking a question as well. Is it going to serve those various professionals or replace those various professionals, right? That's been a source of sort of anxiety. And Steve, let's be transparent. I'm asking partially for myself as a news professional, right, who consumes Reuters content. How is AI sort of being used in that arena? And you all also are working to train some of these large language models using Reuters content. So I'm just curious, sentiment-wise, inside the organization, how that is being received.
Yeah, Julia, it's a great question, and it's one we get quite often. I think it depends on the profession, firstly, and secondly, it's early days. But a couple of observations. The first is, in the tax and accounting and audit professions that we serve, we're one of the largest providers of content and content-driven technology, AI-driven solutions to that profession. There is an acute shortage in talent. So the number of people sort of coming through graduate schools, coming out of undergraduate, going into tax and accounting and audit has dwindled over time. And so therefore, the technology has a real role to play. The number of tax returns is going up, the complexity of tax returns are going up, the complexity of audits is going up. So the demand for the work continues to grow, and the complexity of the work continues to grow, but there just aren't the qualified professionals to get through that work. So the technology has a real role to play. And this will not be one of those cases where, there are sort of layoffs and retrenchments, in my view, because of that talent shortage. And then similarly, if we go across to the Reuters news bureaus, which operate in over 100 countries, we are covering two wars. We are covering seismic changes in demographics, in financial markets, in China, in different parts of the world. The amount of news stories, whether it be breaking news or investigative work, market-moving news that we are across, just continues to grow and grow and grow. And so, similarly, whether it's generative AI or broader machine learning techniques, there's an acute need to integrate them into the news gathering, the curation and distribution process in ways that we haven't seen before, just to cover the breadth of what's going on in the world. So, we don't foresee layoffs or replacement of journalists and editors, photographers, videographers in any way, shape, or form because of that sort of supply-demand dynamic.
And Steve, I want to ask you, obviously there's a lot of companies who are excited about AI, and they're putting time and effort and money, Steve, into this technology. How is your AI story distinct? How is it different than your peers, than your rivals, than your competition?
Yeah, I think it's distinct in a couple of ways. The first is, so we have been using advanced machine learning and AI techniques for 30 years at Thomson Reuters. We put a fully functioning search algorithm on the front of our flagship legal research product, which is called Westlaw, back in the early 1990s. So before Google was invented, we had a functioning search algorithm associated with that digital product. And we've been continuing to invest in machine learning and AI ever since. So I think, without, I hope, a hint of arrogance, we have a level of expertise as it pertains to AI that very few have. And I think that gives us a point of difference. I think the other thing, though, is one of the things that sort of emerged through this generative AI story in the early going in 2023 was the value of highly specialized, unique content. And we have more of that than anyone else who serves legal professionals, tax and accounting professionals, risk and compliance professionals, or news professionals. And that information is incredibly valuable in terms of preventing hallucinations, correcting and training these models. And so, as we sit here today, we're very optimistic about our role in that value chain and proposition, and the idea that as a company, and more importantly, our service of customers will get more and more valuable and be further and further integrated in the work that they do.
Steve, thank you so much for joining us today and taking the time to walk us through your earnings report. Appreciate it.
Pleasure, Josh. Thank you.
Coming up, shares of ARM are soaring today after topping expectations on its recent earnings. We're going to speak to an analyst about the chip company on the other side.
Bitcoin is climbing back above 45,000 and taking related stocks with it. Jared Blickery is here with a closer look. Jared, do we know why this is happening? That's always the first question when it comes to Bitcoin.
Well, that's not why I'm here, Julia,
Okay.
unfortunately. Okay, so we can establish that right now. Bitcoin often trades off of technicals and just pure enthusiasm or the waning of such enthusiasm. Let me show you a 2-month chart here. This was the record high, and I'm going to actually expand this to 3-month and put some candlesticks, and you'll see why in a second. This was the high, and this was right around the time that the SEC approved those spot Bitcoin ETFs. There was a huge lead up to that. You'd have to go all the way down down way to the left side of the chart to see where this began. But all that enthusiasm kind of capped off there. And then we got that sell the news event, and we came back down. We came back down to 40,000 support, and we actually went a little bit below that. So that was a false breakdown. Then we headed back up, and now we are actually exceeding the top end of this range. And you'll notice I'm not including this up here. That I would say is a false break to the upside. So we're well within this territory right now, and it looks like we're just going to head towards that next big psychological target, which is probably 50,000 right up in here. As to particular reasons why, I don't know. But I will say this, the Bitcoin ETFs overall have attracted a lot of volume and a lot of interest. And here's Eric Balchunas over at Bloomberg. He's tweeting IBIT, that's the iShares BlackRock Bitcoin ETF, now is in the top 5 of year-to-date flows, which means it's taken in more cash than 99.98% of ETFs. Not bad for 17 days old. And I would add, it didn't even start at the beginning of the year. Here it is at number 5, and compared to the other ETFs above it, very impressive. Those are general market ETFs. So it's all in for the spot Bitcoin ETFs, and the marketing is really just gearing for the future. And that's what we're thinking about here in terms of investors, the future.
All right, Jared, thank you so much for that. Appreciate it. Meanwhile, shares of ARM Holdings, they are soaring and to a record after exceeding analyst estimates. Chip designer also delivering an upbeat outlook thanks to AI. Companies signaling growth will be driven by the need for more energy efficient compute and AI capabilities. And joining us now is Patrick Moorhead, More Insights and Strategy founder, CEO, and chief analyst. Patrick, it is always great to see you, and let's just dig right in here. So ARM reports, Patrick, investors clearly like what they see. You've had time to kind of look over the report. I want to get your take on the results. And also, Patrick, maybe just help us explain the exuberance we're seeing today.
Yeah, thanks, Josh. So it doesn't get much better than this, right? They had a beat in the beat for the quarter. And next quarter they raised annual guidance. And I look back at when I was commentating on this right before they went public, talking about their growth opportunities. And I feel like what we're seeing now is some of that realization setting in. So this combination and direct connection between what the company says and what the company is doing. And it makes perfect sense to me, right? You've got the overall market growing, driven by AI. They have market share gains in both infrastructure with the likes of Amazon Web Services, with Azure, with their new Cobalt processor, and also in cars. And then inside the markets that they're in, like smartphones, they're increasing content there. They're expanding their footprint in PCs, and then finally, they're adding more of these white glove services so that their end customers don't have to do all of the heavy lifting to build their chips. So what we see here is exactly the result of that.
Patrick, all of that sounds great, but the stock is up 49% today. And we're not talking some penny stock. I mean, this is a more than $100 billion company with the gains that we're seeing today. Like, what? I mean, again, what you said was good, but what accounts for the extremity of that move that we're seeing?
So I'll say that this is rich, okay? And when I look at, particularly when I do it on a comparison basis to, let's say, an Intel or a Qualcomm or even an NVIDIA, right? And I think what investors are expecting is that ARM is going to get into some areas that it wasn't in before, that it will likely run the table on infrastructure, right, which wouldn't be good for AMD and Intel, but that it could be very, very big in PCs that would be very beneficial to companies like Qualcomm out there. So, yeah, I think this reaction, they're betting on a lot into the future, and maybe even things that aren't on ARM's roadmap yet.
And Patrick, you know, for investors who are listening right now and they're looking for smart ways to play AI, and we've talked about this with you on the show before, and, you know, Microsoft, NVIDIA, would you, Patrick, as somebody who knows this company backwards and forwards, would you also consider ARM to be a smart long-term play on that broad secular AI theme?
Yeah, I think ARM is an AI play, and quite frankly, and not too many people talk about this, but those in technology get it. Most AI is actually done on the CPU, okay? And that's contrary to popular belief, but it's just a fact. Now, the industrial strength training of these models is done on GPUs, which benefits NVIDIA and folks like AMD, and in the future, Intel. But most of the inference, which is running those programs, is still done on CPUs. And I always like to say, until NVIDIA and AMD find a way to boot a GPU, you're always going to need a CPU along with it.
And so, Patrick, speaking of inference, what does this imply then about the broader chip universe? You know, there's been like this desperation on the part of investors to find the next NVIDIA. Maybe that also accounts for some of what we're seeing today. Where else then do people need to be looking, particularly if, as you say, there is a big opportunity in CPUs as well?
Yeah, I think we can just take what ARM just did, and for every ARM win, you have a customer that's winning. And who is ARM's largest customer? It's Qualcomm from a licensing standpoint. And the other ones are folks like Amazon Web Services and folks like MediaTek, people who are benefiting from that. So that's the first place that I would look, which are what are some of the companies that are benefiting that may be potentially overlooked out there. I think that's the first place I would start.
Patrick, thank you so much. Always good to catch up with you, especially on a day like this and a move like this. Thanks a lot.
Thanks.
Well, coming up, Tesla will restart operations at its Giga Berlin factory following a production halt due to Red Sea tensions. We'll discuss the latest from the EV maker on the other side.
The S&P 500 is creeping near 5,000 for the first time ever. And once again, the stocks leading the way, the largest stocks in the index. But some strategists do not see this narrow contribution as a reason to be wary of the index moving forward. Yahoo Finance Markets reporter Josh Schaefer has been looking into this for us. Joshua.
Yeah, Josh, I was talking to the team over at Goldman today, Ben Snyder over there, and they had a nice note out on the Magnificent Seven recently, and we sort of dug into that together, and they were basically saying the reason we've seen the Magnificent Seven run up hasn't been out of fundamentals, and the reason it might keep moving up isn't out of fundamentals. So, well, it may lead to some sort of pullback in the index overall right now because that's just sort of how things work when we talk about narrow breadth. Concern about where the Magnificent Seven go moving forward maybe isn't totally grounded, and it might actually make sense. And so when you really think about it, you think about what we've seen from this index, you look at margins compared to the other 493 companies, been significantly higher in the Magnificent Seven. We talked before tech earnings last week about earnings projections, right, and how much higher those were for these 7 stocks. And really, I should note, we're kind of talking about 4 stocks now compared to how the tech stocks are doing now. But they basically said the difference they think now between, say, the 2000 tech bubble, and I thought this point was pretty astute, is the big companies now, these big Magnificent Seven companies, they're taking their free cash flow and investing over half of it back into the company. And in 2000, we were seeing about half of that for those big companies. So what they're saying is when you look at lofty earnings projections and how these companies are meeting it, right now, Mag 7 stocks are actually putting their money back into the company, investing in things like AI. And that's how you're seeing this big earnings growth. So maybe we don't see quite the bubble that we saw last time because they're putting the money actually back in to grow.
Well, and they actually are making money, which is also another difference. There are, far fewer companies back then were actually turning a profit at all. So that's another difference.
Yeah, and you think about NVIDIA, right? And I think one thing that was interesting that we talked about with NVIDIA, that stock has absolutely surged over the last year.
Right.
But look at the PE on NVIDIA.
Yeah.
The PE on NVIDIA was, say, 50 a year ago, and now it's closer to 30, right? So it's trading higher because earnings are going higher.
Yes.
Fundamental analysts would tell you that's a good thing.
That's what Stacey Raskin recently told us, that he still thought it was attractively priced here at these levels. Thanks so much, Josh. Appreciate it. Well, luxury brands Tapestry and Ralph Lauren soaring in today's trading. Both companies reporting positive prints earlier today. Ralph Lauren shares hitting a 9-year high on price increases, and revenue also rising, led by a strong rebound in China. Tapestry boosted its full-year guidance for adjusted earnings per share, with the Coach brand being the main driver behind its sales momentum. Let's bring in Jessica Ramirez, Jane Holly and Associates, Senior Research Analyst. Thanks for being here. What is driving the strong performance here? Is it China? Is it luxury demand? Or are there sort of individual things that each of these companies are doing right?
Thank you for having me. In terms of what is driving, I think there is a bit of, as you said, different parts that are driving the business and why we're seeing better results. And ultimately, we are seeing better margins. If you look to Tapestry, for example, Tapestry, in terms of Coach, they do not run wholesale, and wholesale has been a weakness in North America, which we saw the drag with Ralph Lauren and that becoming their comps being flat over the Ralph Lauren story. Now, in terms of Tapestry, they do not have wholesale. They are a digitally run business. They do focus on DTC. They innovate their product. They localize their product. So when you speak about the Chinese consumer and localizing in that region as well as the rest of APAC, that is very much, again, consumer centric, and that will help them. In terms of Ralph Lauren, I mean, AURs are also a great story there. They've continued to raise them quarter after quarter. That is a similar story also at Tapestry. So in general, both of these companies, what they do share in common is they're running a much smarter business. They're very nimble and they're very focused on driving what the consumer wants and where they're able to spend that extra bit.
And Jessica, on Ralph Lauren specifically, interested to get your take on the CEO there. Just kind of his tactics, his strategy, Jessica. How much of an impact has that made for this brand?
Yeah, Patrice, I think, has been running a very smart business, and it's been very focused in running, again, a very nimble business. So from an operational standpoint, increasing digital, looking towards pushing on its core products and really heritage. So Ralph Lauren, I think, sits in a nice sweet spot in terms of if the consumer is strapped for cash and is looking to spend, they will spend on a brand that they trust, a brand that has longevity, a brand that has heritage. Ralph Lauren sits under that. And in terms of the true luxury consumer, I mean, the price points go up. And he's talked about, the value of his cashmere and the beautiful cashmere that they do carry with very high AUR. So he's able to tap into all of that. They've brought in the younger consumer, which makes a lot of sense. They're on Roblox, they're on all sorts of platforms that younger consumer is shopping and is being inspired by. So I think his tactic is very smart. Today they talked about AI in terms of looking at how to bring in inventory and be smart about inventory strategy as well as pricing strategy in store. So they're testing that. I quite like to hear that. I think AI in terms of retail strategy can be very helpful, especially if you are a data-driven business, which Ralph Lauren has started to really drive in recent years.
Jessica, there was one more company in this category that reported today on the even higher end. I'm talking about Kering, which owns Gucci. And Gucci didn't do as poorly as estimated. But how should we read that through to the sort of even ultra luxury consumer?
Yeah, so Kering's been an interesting story. Obviously, with Gucci, we did have some falls last year. Now, part of that has been due to the consumer that shops luxury maybe 4 times a year started pulling back. Gucci was very much banked on a lot of logo product, and a lot of the logo product tends to end on that entry point level. So again, Gucci really had exposed that very largely, and we saw some of those faults come through. Now, once we started seeing that sort of snowball down with Gucci, they did start looking to increase their AURs and focus on that higher spending consumer. Now that makes sense. I think there is time to still catch up with what's going on at Gucci. And in terms of a lot of their other brands that Kering has that have been very logo driven, again, in where we are with the spend with luxury and looking towards true luxury spend, it is, what everyone has called quiet luxury, a much more subtle luxury. So again, in an example of Ralph Lauren, where they're focusing on their core product, that's very subtle. And again, they do tap into that quiet luxury. That's where we see the spend when we compare them to results that we've seen at LVMH or other conglomerates that are luxury specific and have had gains, even though they are slowing down. I think luxury in general is normalizing this year, and that's what we're likely to see. But they are tapping into that higher end spend. And again, that's really where we're seeing the spend in luxury rather than at the lower end. I think that will still continue to be volatile with the consumer.
Jessica Ramirez, thank you so much. Appreciate your insight on luxury and apparel. Thank you.
Have a good one.
Well, Tesla is set to resume operations at its Berlin factory after production was halted due to ongoing trade disruptions in the Red Sea. Yahoo Finance's Prasad Ramani has more. So what's changed here?
So it seems like operations are back to normal there in Giga Berlin. A German publication spoke to a plant manager there, and he said, quote, "The supply chains are intact again. Tesla has the necessary security that all necessary production parts are available in sufficient quantities to be able to fully restart." So at the end of January or so, they had to shut down production of the Model Y because they didn't have the right parts that couldn't get through that Red Sea, Suez Canal area because of the Houthi military strike. So it seems like they've gotten the parts back. They probably have to go around the Cape of Good Hope and think other kind of extreme ways to get these parts, but they have enough in sufficient quantity to build these parts. So like I said, it was down since the end of January. The plant was making at peak around 6,000 units a week of Model Y cars. So maybe lost anywhere from 10 to 20,000 units for that run, which isn't much considering the fact that Tesla made 1.8 million cars next year. But nonetheless, good news for a company that has seen its stock sort of get hammered recently for other various pieces of bad news.
Yeah, I meant to ask you about that because Dan Ives over at Wedbush, Prazi put out a note today saying, and obviously Ives, big Tesla bull, outperform on the stock, but he was saying, he's covered the name for a long time, and just said the Tesla narrative, the Tesla story, he said, in his opinion, it's like the most negative he has now seen in years.
Yeah, and he had, I think it was the call for 3 things he needs to change.
The board wants to,
Yeah, the board should do right. So authorize a move to Texas, new comp package, a couple other things to kind of get the narrative back and to get kind of the investors back on board. I mean, a big part of that is, and he's calling for Musk to get that 25% back in shares. I mean, I don't know if that's going to be the reason that's going to make the stock go up because of the fact that Musk has more shares.
But wasn't that though? Was that Praz kind of a reason though we saw things get negative? I mean, yes, it was the print and the call and the worries about the EV market. But how much was that? Because Musk then said, "Listen, you give me 25%, or I pick up my marbles and I go someplace else. My AI robotics products, I'll go someplace else." I mean, that was part of it, right? That got people nervous.
Right, the possibility of maybe not him leaving, but taking that piece out and make it a private kind of which he has various private companies outside of Tesla. So the fear was that leaving that AI stuff, the Dojo stuff, all going, they want to keep that in the company.
Yeah. All right, we'll keep following it.
Yeah.
I think we're going to keep talking about it.
Yeah.
Thank you, Praz. Appreciate it.
You too.
Coming up, closing bell on Wall Street, the S&P 500 trading near that 5,000 level and getting the latest earnings from Affirm, Pinterest, Take-Two, and many more. Stick around, all your market coverage after this.
There is the closing bell on Wall Street. So let's do a check of the market. The S&P 500 did touch 5,000, but it doesn't look like it's going to end there unless we see quite a bit of bouncing around at the close here. So on an intraday basis, the S&P 500 did touch that 5,000 level. Remember, any gain today does mean another record close for the index, even if that gain is only 0.06%, which is it looks like it's going to be here. The Dow climbing about 49 points here, up 0.1%. I believe the Nasdaq 100 at another record today as well, as we see continued strength among some of those tech mega caps helping power things higher here. But we've been seeing energy stocks as among those that are doing the best.
So close, right there, knocking right at it.
Knocking at that door.
Right.
Seems inevitable.
It does. Let's get to some tickers here. We're going to start off with shares of Oscar Health, surging on strong earnings. Julie, the insurance startup, also expecting to be profitable for the first time this year. So health insurance, that's the name of the game, reports pleases for Q4, smaller than expected loss. Revenue was up 44%. The forecasts also look solid. Adjusted EBITDA for 2024, that was better than expected.
Yeah, and our Anjali Kamlani talked to Mark Bertolini, who is the CEO at Oscar, and he talked about the sort of different business lines that the company has, including one for small businesses called Cigna Plus Oscar. He indicated that maybe that business is not doing as well, and he says it's not making money here from an underwriting standpoint. So we didn't get any comment from Cigna on that, but that is something to continue to watch here. A little, we keep talking about the class of 2021 IPOs today. It just keeps coming up. Oscar is one of those as well. It came public in March of 2021 at $39 a share. So you can see, even though it's had a recovery over the last year, it's still trading well below that IPO price. Well, let's talk about one that is under pressure today. That is Lightspeed. It did top estimates on the top and bottom line in the third quarter, but delivered a cautious macro outlook that seems to be responsible for that big drop of 24%. This company, based in Canada, it's a point-of-sale company, caters to restaurants as well as golf courses and small businesses here. And so it's interesting that we are seeing this large reaction to these numbers.
Yeah, the caution was in part on that macro backdrop, and just looking through some of the analyst notes today. Stifel, for example, told their clients they see macro risk for this name as a key headwind in the near term, and that in part is why they were telling their clients that they're on the sidelines for now.
Yeah, and Wells Fargo looking at gross transaction volume that appears sluggish, which they say raises some skepticism about the shares as well.
All right, final name here. Let's check out Kellanova, formerly known as Kellogg, topping analyst estimates on the top and bottom line as price increases offsets elasticity on volume. You can see the shares popping about more than 2% there in today's trade. So the packaged foods company, Q4 adjusted EPS, Julie, 78 cents. That was a beat. Sales, $3.17 billion. That was also a beat. Did affirm annual guidance as well.
Yeah, and that seems to be key as well. It's so expectations. The expectations game is so important. We've been talking about some names in recent days that reaffirm their guidance, and that's a disappointment. In this case, they reaffirmed the guidance, and it was reassuring here. Remember, Kellanova spun off that North American cereal business, and some analysts are saying that this quarter seems like a bit of a confirmation that that was the right thing to do here. And organic growth in particular, it's interesting to see that return for some companies like Kellanova.
Yep. All right, we move on. The S&P 500 edging higher on the day, but the index did briefly hit that 5,000 mark for the first time ever. The index continuing its upward trend here since the start of the year, boosted by economic data and upbeat earnings. Here to unpack what that 5,000 mark will do to the economy is Dan Griffith, Huntington Private Bank Director of Wealth Strategy. Dan, it is good to see you. So we were knocking right on that door there. We like big round numbers, right? You said something interesting though, Dan, which is you think actually this is going to be, I think you put it like it's going to be the year when investors exhale a bit in the stock market. What do you mean by that?
I think that's the case. I think a lot of, one of the themes for the year is going to be that we're range bound a little bit. There's a lot of optimism, but it's going to be a lot of cautious optimism. And we see in the past when we hit these big round numbers, the market will test it a little bit and kind of go back up again. And I think that will probably be the case here too.
Why do you think that is? I mean, as we've been talking about this theme recently, that the backdrop looks strong, right? We've got earnings that have just come in, beat estimates at a faster rate than they have in recent quarters. Economic growth keeps beating estimates. and stocks keep climbing to records. So what could go wrong exactly?
Well, I think I agree with you that a lot of the fundamentals are pointing in the right direction. And I mean, if you look at what the core fundamentals are that we're watching most closely, there are a lot of what you mentioned, Julie. We're looking at what does unemployment look like? Well, we continue to get good numbers. We did, earlier this week, today, and we did a couple weeks ago. We look at what core inflationary numbers are. Those continue to look very positive. Probably not down to the 2% that the Fed wants, but those look really solid. Consumer confidence remains solid, even in the manufacturing sector, which we deal with a lot with at Huntington. They continue to look solid as well, and there's a lot of optimism, both in the overall numbers, and as we talk to clients individually, they express optimism too. So I think it's really a matter of what, like you said before, what could possibly go wrong. I think it's more along the lines of, we want to make sure that we don't think that it's going to go incredibly right? That we want to manage optimism. And that's why range bound is the theme, as I said before.
And as you try, Dan, to sort of gauge where the economy is headed over 2024, you're trying to, is it soft landing, recession? How are you gauging that? What's the data? What are the financial metrics you're watching?
I think a lot of them are the ones that we just described earlier. And I think we're thinking that there's a potential of a slowdown. We're at 50-50 as far as a recession, likelihood of recession in 2024. We've been that way for the last probably 2 years, frankly, and it's been a wonderful position to be in. The market kind of was a little less optimistic than we were, and now it's kind of come the other way and met us where we are at Huntington. But at the end of the day, I think we think if the Fed's going to maybe lower rates a couple times as the weather gets a little warmer here, probably 3 times is what our guess is. Then if we are going to have a slowdown, it's going to be a pretty modest one. And we're still optimistic about what the future holds as far as the market is concerned.
What are you hearing from clients? I mean, as you said, you deal with a lot of manufacturing clients. You're in the private bank, so you're talking to wealthy individuals.
Yes.
What's the sentiment like?
Well, I think a lot of them are concerned, right? A lot of people are concerned about, hey, we've had a really good market, particularly last year. Everyone was worried about a recession. But what I hear from clients is that they're a lot more prepared than they were. Whether it's public companies or private companies, a lot of them tightened their belts in 2022 to prepare for what they thought was an impending recession in 2023. Of course, as we all know, that didn't happen. So I think a lot of them begin 2024 with things like interest rates baked in a little bit more. They just begin 2024 a lot more prepared for a little bit of volatility, and frankly, with balance sheets that look pretty good. So it's a very cautious optimism, but optimism nonetheless.
All right, you'll take a cautious optimism. How many questions are you getting, Dan? I'm just curious from your clients. How often are they asking you about the election, and what are you telling them?
Oh, Josh, I mean, probably, only probably 100 times a day, right? That's one of the things that's on everybody's mind, and how it's going to affect things.
And what are their questions, Ed? What are they asking?
Well, part of it is just, hey, we have an election. How is that going to affect the market? What's it going to do one way or the other? And you can look at some of the historical data and see in the past how have elections gone, and if the economy was doing well, what does that mean? I think this particular election is, as all elections are, is going to be a little bit unique. I think one of the other things is the market has looked around and said, hey, we're going to focus on our side of the house, right? The Fed's doing the same thing. We're going to do what we can here, and almost eliminated politics from the conversation. So although a lot of people are interested in talking about it, I think it's good to look at the numbers, which ultimately is going to make the real decisions.
Yeah, Dan Griffith, thanks for coming in to visit.
Thank you for
Appreciate
having
it.
me.
Nice to see you in person.
Yes.
Thank you.
All right, we got some earnings news that we want to bring you right now. Pinterest, let's start there. That company coming out with revenue that missed estimates, even though earnings per share did beat estimates, and the shares are taking a quick tumble in the afterwards. There was some optimism that was baked in here. We were seeing the shares climb in advance of this, but revenue coming in at $981.3 million. Analysts had been predicting $990.2 million. But the other metrics look pretty good. Adjusted earnings per share at 53 cents. That is 5 cents ahead of estimates. And monthly active users at 498 million. That too is ahead of estimates. I'm also looking at here a first quarter revenue forecast for a gain of 15 to 17% year over year, which would take it to $690 to $705 million. I'm trying to look around to see if we can get that first quarter revenue forecast to see how it compares. But again, that revenue miss, Pinterest really being punished for that.
Yeah, I mean, often, this is a company that does guide conservatively. They kind of, So there is some caution there, and analysts will always be quick to point that out when you look at a Pinterest forecast. It is interesting, though, Julie. I mean, the expectations were high heading into this print. This stock, heading into this report, this stock was on a run. It was up more than 30% in the last few months. It was up more than 50% over the last 12 months. I think some interesting things will be obviously about the forecast, the guidance, the puts and takes they're seeing there. There's going to be a lot of interest in the site's advertising partnership. Remember with Amazon, with pointing that it's going to make it easier to shop on the site. Bulls were very excited about that partnership, so it'll be interesting to see on that call. Also, geopolitical conflict. Remember specifically the Middle East. That did come up on their last conference call. They flagged that, so it'll be interesting to see is that part of the issue as well here on the conference call.
Yeah, and I did get that estimate for first quarter revenue of $703 million. So if their range is 690 to 705, the midpoint would be below that $703 million forecast. So fourth quarter revenue missing, first quarter revenue, the midpoint below what analysts have been anticipating. Bill Reddy, the CEO, in the statement talking about a transformative year for Pinterest, that this fourth quarter capped off that transformative year, it being our most productive year yet, he called it. And he also called out the global monthly active users was a record for the company. So that's something to keep in mind as well. Maybe we'll see a little mitigation of this move, but so far it is a big move downward here for Pinterest.
Yep.
All right, we've got more earnings on tap after the break. We'll have the latest from Affirm and Take-Two and Expedia on the other side. Keep it right here.
Affirm just now reporting results for its fiscal Q2. Let's get those headlines to you. The stock's kind of bouncing around here, Julie, in the after hours, but Q2, they report a loss of 54 cents. That was better than expected. On the top line, they look like they're reporting revenue of $591 million. That was also better than consensus. Looking ahead, Q3 revenue, they're calling for between $530 and $550 million. That looks like a beat. Q3 GMV, so gross merchandise volume, they are forecasting 5.8 to 6 billion. Street was around 5.9 billion. Again, we'll just have to see how it plays out in the after hours. Of course, heading into this report, this stock was a monster, right? I mean, it pulled back a little year to date, but it was still up around 200% over the last 12 months. So this is going to be interesting. I mean, basically behind the bottom and the top, we're looking for GMV growth, gross merchandise volume. Also, it'll be interesting any kind of color we can get about that new Affirm card. Lots of focus on that. Traction, how much of that is going to boost GMV in the quarters ahead.
Yeah, I'm just trying to scan through quickly Max Levchin, the founder and CEO's shareholder letter here, because it is confusing to me just glancing at the numbers why we're seeing the stock have the reaction that it has, unless it's what you're referring to, the context of the stock having performed so well over the past year. He talks about the fastest year-over-year gross merchandise volume growth rate in over a year. He emphasizes that the company has increased its funding capacity. He says they've kept what he calls an unblinking eye on credit, that 30-plus day delinquencies were flat quarter over quarter and year over year. So unclear exactly what is going on here. I mean, something interesting about Affirm is that amongst the sort of buy now, pay later companies, it has really at least portrayed itself as quite conservative, as keeping adequate reserves, as not being too risky in the lending that it's offering. And then again, the numbers on the face of it look good, unless perhaps there were hopes, even though the consensus forecast was for a loss of 54 cents in the second quarter, it's possible that the whisper number was better than that. And so there's also something of a reaction to that. We're going to keep digging in here and figure out what is going on. In the meantime, we got another one for you. Take-Two Interactive out with numbers as well. That company coming out with its fiscal third quarter numbers, and those shares, let's take a look at Take-Two, is also down. Ironically, Take-Two missed, but the shares are not down like they are for Affirm. So Take-Two here, net bookings a little bit ahead of estimates, $1.34 billion, but the company's fourth quarter net booking forecast is below estimates. It's only looking for at most $1.32 billion in net bookings in the fourth quarter. $1.5 billion was what analysts have been looking for. And the company's fiscal third quarter earnings per share missing estimates at 71 cents. So both of those items obviously not necessarily helpful to the shares there, which are down by about 2%. The shares this year, I'm trying to take a look at what they've done. They're up about 5%. So we have not seen the monster gains that some other stocks have seen.
I'd wait and you know what, it'll be interesting, Julie, on this one, I'd wait for the call just to hear what execs have to say, because the big area of focus for Take-Two has been, the Grand Theft Auto franchise, just kind of the great hype around the next GTA game. And actually, and also quick to point out, that hype, that interest, that excitement has actually been sort of, in their opinion, kind of overshadowing near-term financial performance. And some I know, some analysts were saying, like Michael Pachter, our buddy over at Wedbush, is saying, just wait for these trailers to keep coming out. And he was kind of banking on those trailers that he thinks is going to be kind of drive more share price appreciation. That's how much interest there is. So it'll be interesting on the call how much more color and commentary we get from the CEO about that.
Yeah, I mean, I guess it depends also on how patient investors want to be here. That third quarter net bookings number that I talked about was down 3%, by the way. So a year-over-year decline here. And the company also talked about the largest contributors to net bookings in terms of the games: NBA 2K, Grand Theft Auto, as you mentioned, Toon Blast, which is part of their Zynga platform as well, and Empires and Puzzles. I don't know that one, but that sounds like a Julie kind of a game. Empires.
Much more than
Puzzles.
GTA, you're saying. Yeah.
Yeah, no, I'm not a GTA girl. All right, more of a crossword girl. All right, a milestone day on Wall Street. The S&P 500 hitting 5,000, and that was not the only record to talk about. Jared Blickery's here with the rundown at all the records.
Hate to say it, but I'm kind of on repeat here. Nasdaq 100, S&P 500, Dow, all record highs. As you said, the S&P 500 finally top ticked 5,000, and it was actually the high of the day, just a little bit over. But as you can see, closed right underneath it. Not the biggest of deals. I think the only reason, or one of the major reasons why this is in focus, because it's a big psychological number, but also because there's a lot of options activity around there. That influences it as well. But let's move on to the record highs in individual stocks. Microsoft only up by 1 basis point, but that's all you need to get a fresh record. Then Eli Lilly, we got Broadcom, ASML, so we got some chip stocks, some healthcare. There's Costco, that's a consumer staple. TJX, that's consumer discretionary. Packer, that's shipping. Synopsys, that's computers. So you take it all in perspective here. PGR, that's finance. We're seeing more and more of a broad swath of participation in these highs here. Financials, I was mentioning those in the morning brief today. They took a back seat today with utilities and with healthcare. But what was outperforming today? One of the worst sectors of the year and last year, by the way, that would be energy. Energy up 1%, followed by real estate, consumer discretionary, communication services, and tech. And not a lot of outperformance here. If you take a look at the Nasdaq 100, it is a mixed board. You got some winners and losers on the left side in the mega caps, and also on the right side. Not too many big outperformers here, even though we're in the heat of earnings season, or maybe just in kind of the wake of the heat of earnings season. Nevertheless, here are the leaders in sentiment markets that I look at today. IPOs had a good day, followed by Bitcoin, just went over that in the prior hour. We have the disruption trade, ARK up 2.5%. Home builders, they just hit another record high. So did chip stocks. I think those two are notable. Home builders and chip stocks were making record highs last year. Interesting combination. And then we also have small caps. IWM, that was in focus today as well, followed by retail. Now, what did not do well? China, we've been beating that drum. It's either been the leader or the biggest laggard just about every day here. Today, it is the biggest loser, followed by cannabis and emerging markets. Let me check in on our meme stocks here. I haven't done this in a little bit, but we're seeing more green than red. Palantir coming off a couple days ago, its earnings. Coinbase, that is a Bitcoin-based stock, a crypto stock that has done well today, along with the other crypto stocks. That's up 6.5%. Carvana up 9%. So some of the fringier parts of the market doing well today, along with those stalwarts hitting record highs.
Thanks so much, Jared. It definitely still feels like the heat of earnings season where I'm sitting, because we've got another company to talk about. Yeah, let's talk about Expedia. That company just coming out with its numbers here, and the share's down a quick 11% in after-hours trading. Let's run through the numbers here. Adjusted EBITDA in the fourth quarter, $532 million. That was ahead of the $526.8 million that analysts had been anticipating. Revenue beating estimates by a hair here. Adjusted earnings per share beating estimates. The one area of weakness here looks to be gross bookings, which is an important measure for the likes of Expedia. $21.67 billion, $22 billion is what analysts had been anticipating from Expedia. And there's another important piece of news to mention for Expedia. It is laying out a CEO transition plan here. Peter Kern, who has been the CEO of Expedia only since 2020, will be stepping down after he completes his contract here. As of May 13th, Ariane Gorin will become the CEO. She has already been at Expedia since 2013. Most recently, she was the president of Expedia for Business. So Ariane Gorin going to be taking over from Peter Kern as of May 13th at Expedia. What stands out to you here from
yeah, it's interesting. Well, I mean, the reaction in the after hours is pretty tough. I mean, and the stock, though, has been working over the past 12 months. I mean, it's up around 30%. Interested changing the C-suite. Is it Barry Diller, by the way, who is, of course, Expedia's group's chairman, weighing in, saying Ariane Gorin calls her a superb executive, said they very much wanted an internal candidate. It sounds like they've got one. Said they did do a comprehensive search, but the board determined that she was the best candidate in their opinion, just given her leadership. And she has been there a while. I mean, she's a real veteran. She's been at the company, it sounds like, some 10 years at this point.
Yeah, I'm looking at some of the other metrics just real quickly here. Booked room nights up 9%, but operating income down 19% year over year in the fourth quarter.
At least initially, investors not happy in the after hours. Coming up, shares of SolarWinds getting a boost today following a beat on fourth quarter earnings. We're going to speak to the CEO on the other side.
Shares of SolarWinds getting a boost today following a beat on fourth quarter earnings. The software developer saw total revenue grow 6% year over year. For more on the latest results, we're joined by Sudhakar Ramakrishna, SolarWinds CEO and President. Thank you so much for being here. Talk to me about the demand that you are seeing from enterprises right now. I mean, we talk a lot about companies cutting back, right? And then that's one of the reasons that they are seeing gains, but obviously they're still investing in the enterprise as well.
Yes, first of all, thanks for having me here. We are very fortunate to have a very large customer base globally. In fact, we have more than 300,000 customers all over the world, and they're all looking for how do we reduce their complexity, how do we improve productivity, and do it in simple ways. That's what we deliver for them, because every one of them is constrained for resources, and both physical as well as monetary, and we solve their problems, and that's where we are seeing the demand from.
And Sudhakar, top of mind for your investors and financial analysts covering you all on the street is the transition you all are making, Sudhakar, to more of this kind of subscription model. Why do you think you all are well positioned for that pivot?
For us, subscription model is not just a business model transition, it's a value model transition. So every time we go to customers to evolve them to subscription, we are actually giving them more capabilities to help them manage their multi-cloud environments. And that's where we are seeing the lift. We've made it incredibly easy for them to procure. We've made them extremely compelling from a value proposition standpoint, and we've made it cloud ready, where they can start with where they are and evolve at the pace at which their business needs dictate. So we are giving them kind of a best of both worlds, and that's what is getting them attracted towards us.
And Sudhakar, also you're making this interesting push into the observability market. So, for example, software that monitors apps. Lots of competition there, though, right? I mean, Splunk and Datadog. Why do you think, Sudhakar, you're well positioned to kind of compete and win in that market?
Yes, SolarWinds has always been excellent at monitoring capabilities, networking, databases, applications, and systems. So what we have done is unified all of it onto a single entity, which is a SolarWinds platform. And we're able to give them better ways of integrating across all of these. So whereas some of the competition is looking at whether it be an application or an infrastructure or database discretely, we're able to pull together all of these, give them a comprehensive visibility, thereby helping them reduce the time it takes for them to detect issues and solve issues. So thereby improving productivity and reducing cost, and overall improving their security as well.
I want to switch gears, Sudhakar, to talk a little bit about the SEC case that is ongoing with SolarWinds that had to do with what happened before you became CEO, a large hack at the company. And the SEC is basically saying that SolarWinds did not disclose enough and is trying to impose some new rules about disclosure. Well, you were pushing back against that, but you've also been joined by a number of other companies in that quest. What's wrong with more disclosure? Help people understand the case that you're trying to make here.
Absolutely. I think the SEC's efforts to improve disclosures and levels of disclosure is the right thing to do. However, our stance is that we have always been excellent at disclosing events as well as being very proactive and transparent. So in many ways, it seems like the right intent, but the wrong target. In essence, we feel victimized for being the victim of one of the largest and the most sophisticated attacks. And no company is immune to these types of attacks. So even since, though, we've been continuing to improve. And I think the overall industry is rallying behind us because they all understand no one company is able to address a nation state attack. We all have to work together as a community. And if you put too many restrictions, then it actually precludes us or actually disincentivizes us to come out and share openly and create more asymmetry in this security war. And so that's the reason why I feel everyone is rallying behind us. We are very confident in our facts, and we are hoping that everyone will see it that way and will put this matter behind us and focus even more on our customers and our employees.
And Sudhakar, I want to get you out of here on this question. Obviously, a boom of interest in AI. How much are you fielding questions from your clients, Sudhakar, about AI, and how are you positioning your company to kind of take advantage of that big trend?
We have been investing in AI-related technologies from 2021. In fact, we call our solution an AI-powered stack. But more specifically, we use AI to help customers detect issues in their environments much faster and remediate them. So there's a very practical use of how we leverage AI across our entire portfolio, be it in observability or in service management. And so that's been resonating really well with our customers. But I'll say we are in very early stages as an industry in the evolution of it.
Sudhakar Ramakrishna of SolarWinds, thank you so much for your time today. Appreciate it.
Thanks again.
Well, Disney shares jumped today on the back of its latest earnings report and strong guidance for 2024, but the House of Mouse was not built in a day. Yahoo Finance took a deeper dive into the history of the Walt Disney Company as we go beyond the ticker.
From Hollywood blockbusters to theme parks branded as the happiest place on earth, the Walt Disney Company has built itself into an entertainment juggernaut. The media giant generated total revenue of nearly $33 billion in 2023, an increase of about 16% year over year. Beyond the Ticker dives deeper into Disney's success and how it became a household name. In 1923, Walt Disney and his brother Roy established Disney Brothers Cartoon Studio in Los Angeles. 5 years later, New York's Colony Theater premiered Steamboat Willie, the first cartoon released with synchronized sound. It also marked the debut of Mickey Mouse. Disney eventually released its first feature film, Snow White and the Seven Dwarfs, in 1937. The film saw instant success, becoming the highest-grossing title of all time to that point. Disney's first theme park came about a decade and a half later, with California's Disneyland opening its doors in July 1955. It was regarded as the first modern theme park in the United States. 2 years later, Disney hit the stock market with an initial public offering price of $13.88 a share. In December 1966, Walt Disney died at the age of 65, but his legacy would most certainly live on. Walt Disney World, named in the filmmaker's honor, opened on October 1st, 1971 in Orlando, Florida. But as Disney began to evolve as a company, so did its leadership team, with famed CEO Michael Eisner taking over the position in 1984. In his first 4 years, Disney surged from last place to first in box office receipts among the 8 major studios. In 1996, Disney merged with Capital Cities ABC for $19 billion. At the time, it was the second largest merger in U.S. history. And then, the Bob Iger era. Iger succeeded Michael Eisner as CEO in 2005, setting off a chain of events that included a slew of famous acquisitions. Under Iger's leadership, Disney became an equity owner of Hulu and also acquired all of Marvel Entertainment. He led the acquisition of Lucasfilm, coughing up about $4 billion for properties that included Star Wars and Indiana Jones. He also bought 21st Century Fox for about $71 billion in one of the largest media purchases ever. Shortly after, the company launched Disney+. The streaming service officially surpassed Netflix with 221 million total subscribers in 2022. That same year, Bob Iger returned as CEO in a shocking executive shakeup. He had hand-selected Bob Chapek as his predecessor just 2 years prior, but chose to return amid multiple controversies and a sinking stock price. One of those controversies included a battle with Florida Governor Ron DeSantis. Following Iger's return, Disney sued DeSantis, accusing him of violating the company's First Amendment rights by utilizing political power for, quote, government retaliation. A federal judge dismissed the lawsuit, determining that Disney's position ultimately lacked standing or the right to sue. Disney has filed a notice of appeal. Although the future remains unclear with proxy battles, linear network declines, profitability struggles, and slowing theme park attendance, Iger appears committed to bringing back Disney's magic.
New mortgage rate data out today. The 30-year fixed rate mortgage ticking up slightly, and a new report shows how housing stocks are dependent on mortgage rates. Here to help break down all of this data is Yahoo Finance's Danny Romero. So the mortgage rate going up, that's not what a lot of people want to hear.
Well, but it is softer, though. These are softer rates are setting the tone for housing stocks. And analyst at Bespoke Investments, Jake Gordon, says that housing stocks are in sync with mortgage rates. And so suggesting that lower rates means a bullish view for housing stocks. And he's really basing his analysis on the performance of iShares US Home Construction ETF, which is a ticker ITB, and the inverted 30-year fixed mortgage rate. And both of those lines really do go in tandem. And so when rates go up, that means that ITB falls. When rates fall, ITB rises. And so that really points and paints the picture that if you want to know where housing stocks are going to land, look at mortgage rates.
And so home builders benefited, Danny, from this high interest rate environment by offering incentives. Is that still at play this year?
That's the big debate across small home builders and big home builders. And recent data from the National Association of Home Builders really does show that 31% of builders slashed home prices, and that is the lowest rate since August, while 61% of builders only offered some form of an incentive, and that hasn't really changed since October, excuse me. So while this survey really just is casting a net on the smaller home builders, the big home builders are also discussing it too. D.R. Horton said that they're not going to be pulling back on incentives. KB Home said that they would. We'll have to just wait and see this year, especially how everything is kind of rolling out. I think it's really up for debate of whether or not they will actually pull the plug on these incentives.
All right, we'll keep watching. Thank you, Danny. Moving on, a new survey out by Redfin saying home buyers are increasingly factoring politics when deciding where to move. But with mortgage rates ticking up slowly today, the dream of buying a home continues to be, of course, a struggle for many Americans. For more on this survey and the housing market in 2024, we're talking to Redfin chief economist Daryl Fairweather. Daryl, thank you so much, as always, for joining the show. I got to say, Daryl, some of this didn't really surprise me, that the survey and study you guys all did, because I in my own life, I have a buddies who moved to Texas and Florida, and I wouldn't say, Daryl, politics was, the reason, but it was certainly a factor. But apparently, they're not alone. This is kind of a trend you're seeing.
Yes, we surveyed real estate agents, and a third of agents said that they were working with a client last year who was relocating due to politics. And this is up from the last time we did a survey. So it just goes to show that people are becoming more polarized, and it's becoming something that real estate agents need to be ready to talk about, is what is the political climate of the cities or metros that people are moving into.
Daryl, I have to say I was trying to figure out exactly how significant it was, right? Because it's 1/3 of real estate agents surveyed said at least one client, and presumably they have a lot of clients, right, said that they were moving for political reasons. And I don't know if you can sort of separate out political reasons from tax reasons, right, which a lot of people factor into their home buying and location decisions. Like, in other words, it seems kind of murky here.
I think you're right. Political can mean all sorts of things. Anecdotally, we've heard that people were at first moving for economic reasons. They were moving for affordability when they left places like California for states like Texas and Florida. But when they got there, they realized that there were other trade-offs that they were making related to the political climate, the laws that have been passed in recent years. So I think that sometimes politics aligns with economics and sometimes it doesn't.
I also wonder how much of that could be, the big trend we've seen of more people can now work from home, right? And that just gives a lot more Americans a lot more flexibility, and if you so choose, you have that, I guess, more flexibility now to move to an area better aligned with your own personal politics.
Yes, people have been able to move for all sorts of reasons because of remote work. It used to be that the job that you had was the first reason you would move. But now people are factoring in other things, whereas job location is less important, especially for people who have the option to work remotely.
Let's just talk about mortgage rates for a minute, because we haven't had a chance to check in with you in a little while about that. Man, they're not coming down much, are they, Daryl? I mean, is this level still sort of around 7% or close to 7%? Is that enough to make a dent here in the weakness that we have seen?
It seems to be making a dent. Compared to the fall, rates have come down, and that has boosted demand in recent weeks. We've seen that in our data. We've seen prices come in higher than we were expecting. We've seen more growth in sales in places like California that were hit hard by high rates because of how expensive homes are there. So even this little movement in rates seems to be encouraging buyers, and buyers are considering all kinds of factors like the strength of the economy, their job security, and that is motivating them to make a big purchase.
So here's my big question, Daryl. So Mortgage News Daily says the 30-year fixed here, 6.97%. Where do you think, Daryl, that is 6 months from now or 12 months from now?
I think that it will come down perhaps 200, 300 basis points, but there's going to be a lot of volatility. It will bounce up and down. It will take some big news for it to come down substantially, something that shows that we really are winning this inflation fight. And as we've heard time and time again from the Federal Reserve, they don't see the fight as being over yet.
Daryl, thank you so much for joining us. Always appreciate your time and insight.
Thank you.
As earnings season rolls on, Yahoo Finance is keeping its eyes on Airbnb. The vacation property rentals company is set to report next week, and investors will have their eyes on that gross booking value number. Let's take a deeper dive now into what to expect from Airbnb.
Airbnb, a company that's become synonymous with travel and leisure. Airbnb is now a verb in its own. The last time the booking platform reported a solid performance, it was overshadowed by a less than rosy outlook for the fourth quarter. So, what should you look out for this quarter? Here are 3 things you need to watch. Number 1, booking growth. Looking out for 2 key metrics. First, gross booking value. That's the total amount of payments processed on the platform, everything from host payments to cleaning fees, but it does not include cancellations. Last quarter, gross booking value landed at over $18 billion, a 17% gain from the prior year. Then there's nights and experiences booked. The platform reported over 100 million bookings for the quarter, which topped Wall Street estimates. Now, as we turn to the fourth quarter, the revenue figure will be closely watched as the company guided a little below expectations. Number 2, international expansion. In the last quarter, Airbnb said their expansion plans into international markets is gaining momentum. Keep an eye out on what is called underpenetrated markets. That means a market with little competition for the same service. Asia Pacific is one, but also take into account markets like Germany, Brazil, and Korea. Beyond that, it's important to have a pulse on anything the company has to say about AI and how it could be a game changer for international growth in the coming months. Lastly is regulation, another key area to watch. In the third quarter, Airbnb slightly saw higher prices for short-term rentals, but this area could be hurt by changes in the regulatory landscape. For example, New York City's new law requires all short-term rental hosts to register with the city. They must show when their guests are staying, and only 2 guests can stay at a time. This applies to all other platforms like Vrbo and Booking.com. The big question here, will other cities follow suit? And what could it mean in the long term? There's a lot to digest as we look at Airbnb's fourth quarter earnings, and Yahoo Finance will be tackling the latest developments.
Let's take a look at some tickers trending in after hours. Shares of Cloudflare are soaring in after hours trade. They were up as much as 20% right now, up by about 14%. The network service company's forecast for the first quarter exceeding expectations, or at least in line with expectations here. The company's fourth quarter earnings beating estimates by 3 cents a share here. Revenue for the first quarter, Cloudflare sees as $372.5 to $373.5 million. $373.3 million is what analysts have been anticipating. CEO Matthew Prince calling the quarter exceptionally strong, citing robust demand from large customers and growth in the company's Cloudflare One platform. And we're also watching shares of Expedia, which is sliding on its earnings. Results were mixed, including the key metric of gross bookings. Earnings per share coming in at $1.72. The estimate was for $1.69. And the company is also announcing a CEO transition plan. Ariane Gorin will be replacing CEO Peter Kern in May of this year.
And time now for What to Watch Friday, February 9th. On the earnings front, Pepsi, Enbridge, Honda, Blue Owl, and AMC Networks, they are all reporting tomorrow. Enbridge announcing fourth quarter earnings before the bell. The energy giant embroiled in a tense legal battle with the Bad River tribe in a case that is the two fighting over the fate of oil and gas pipeline running across northern Wisconsin. Federal appeals court listening to oral arguments today.
Moving over to the Fed, Dallas Fed President Lori Logan speaking tomorrow afternoon, continuing the parade of Fed speak this week. And it's coming after Richmond Fed President Tom Barkin echoed other Fed sentiments for the central bank to take its time with rate cuts. Barkin also describing the data as remarkable when it comes to showing that inflation is dropping. He said that during a speech at the Economic Club of New York.
And finally, tune in for another episode of Yahoo Finance's Goodbye or Goodbye tomorrow at 3:30 p.m. Eastern, where we help navigate the best moves for your portfolio.
And also some additional things. You mentioned the Blue Owl will be out tomorrow. Blue Owl Capital, not necessarily a household name, but it is one of these companies that has been talked about as providing private credit. You know, a lot has been made of the growing area of private credit that is non-bank entities that are making loans. And some have raised flags about the growth of this area that could be a risk going forward. Blue Owl kind of serves the mid-market, and it seems like just looking at some of the anticipation for the numbers, there is not as much concern around it, but it's the reason I'll be watching it closely. It's sort of a read on that private credit sector.
All right, you're watching private credit. I'm going to be looking at snacks.
Okay.
Maybe some soft drinks. Pepsi, Q4 earnings before the bell tomorrow. Stock is up about 2% this year. Doesn't sound like much. Still, though, it's a bit better than rival Coca-Cola. Looking for core EPS of $1.72 on revenue of $28.34 billion. Team at Bernstein, Julie, saying recent U.S. data signals business might have delivered negative growth in Q4, says Europe also looking kind of weak, and the bar's been kind of set high, so we'll see what they tell us tomorrow.
The price to volume calculation has been really important for Pepsi and for other food companies over the past year, so we'll see if they're starting to see more of a recovery in volume.
What's the snacking like?
I don't know.
We'll find out.
We're going to find out. It's been pretty strong, the snacking.
In the Lipton household, very strong,
I'm
very
sure
bullish. Yeah.
That doesn't surprise me. All right, that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.